You are welcome to Unit 4, Session 2. In this session, we are going to look at conditions for granting capital allowances and classes of depreciable assets. By the end of the session, you should be able to outline the conditions for granting capital allowances, classify depreciable assets into the various classes for capital allowance computation, and state the rates of capital allowances for the various classes of depreciable assets. Section 14(2)(a) of Act 896 says that capital allowance is granted in respect of a depreciable asset owned and used by that person for business. A depreciable asset is defined under the third schedule of the Act as an asset to the extent which is used in carrying on a business, which the asset is likely to lose value because of wear and tear, obsolescence, or expiration of time, but does not include trading stocks. So we are talking about non-current assets when we take it to accounting. Production of income for any business requires the use of non-current assets in addition to other assets. Obviously, as these non-current assets are used over and over again, they lose their productive capacity. Accounting principles recognize this and calculate depreciation in determining their profit. In taxation, the erosion of the productive capacity of non-current assets is also allowed as a legitimate business deduction, even though the deduction of the entire cost of capital assets in 1 year is disallowed. From taxation point of view, the amount quoted by the accountant as depreciation is disallowed due to partly the arbitrariness of the determination of depreciation rates and the method used. Thus, capital allowance are granted in lieu of depreciation. So there are certain conditions for granting capital allowance. First, capital allowance is granted on depreciable assets. Then the depreciable assets must be owned by the person. Also, that depreciable asset must be used in carrying on the business of the person during the relevant basis period. That depreciable asset must also be owned at the end of the basis period of the person ending within the year of assessment. Capital allowance granted in respect of a particular year of assessment shall not be deferred by a person entitled to that capital allowance as provided in Section 14, Clause 3 of the Act. So please take note of these conditions. Capital allowance are granted under Section 4 of the Income Tax Act 896 and in accordance with the third schedule. The Act classifies qualifying assets or depreciable assets into 5 classes. That is Class 1 to Class 5 and works with the pool system that existed under Act 592. It allows 2 methods of depreciation, the reducing balance method and the straight line method. Classes 1, 2, and 3 are placed in separate pools and depreciated on the reducing balance basis at specified rates. Classes 4 and 5 are to be placed in a pool of its own, separately from other assets of that class or any other class. They are depreciated on a straight line basis at specified rates. We'll look at some computation in the next session. So let us look at the various assets under the various classes. For class 1, we have computers and data handling equipment together with peripheral devices. So we can have printers, photocopy machine, etc. And the rate is 40% reducing balance method. Then for class 2, we have automobiles, buses and minibuses, goods vehicle, construction and earth moving equipment, heavy general purpose or specialized trucks, trailers, and trailer mounted containers, plant and machinery used in manufacturing. The rate is 30%, also reducing balance method. Under class 2, we have assets resulting from expenses incurred by a person in the production of income of that person in respect of planting vegetation from which timber, rubber, oil palm or other crops are derived, and where the business is a timber concern or a large-scale rubber, oil palm or other long-term crop plantation, also 30% reducing balance method. Then for class 3, we have railroad cars, locomotives and equipment, vessels, barges, trucks and similar water transportation equipment, aircraft, specialized public utility plant, equipment and machinery, office furniture, fixtures and equipment, and any depreciable asset not included in another class. So for example, we can have refrigerator here, etc. And here we also have 20% reducing balance method. Then for class 4, we have building structures and similar works of a permanent nature, 20% straight line method. It's 10% straight line method. Then for class 5, intangible assets, we have useful life. This brings us to the end of today's session. In this session, we dealt with conditions necessary for granting capital allowance, and we said that the asset must be of capital nature, it must be owned by the business, and it must be used in the production of income for the business. And we also said that capital allowance cannot be deferred. We also looked at the various classes of the depreciable asset and their rate. We have class 1. Class 1 deals with computer and data handling equipment or devices, and the rate is 40% on reducing balance method. We have class 2, 30% reducing balance method. We have class 3, 20% reducing balance method. We have class 4, 10% straight line method, and we have class 5, which is useful life, also on straight line method. Hope you enjoyed this session. Thank you.